Understanding investment return. A simple guide. Hello and welcome, everyone. Today, we're going to explore a key financial term that's crucial for anyone interested in investing: investment return. Whether you're just starting out or looking to deepen your understanding, this video will break down what investment return means in a clear and accessible way. Let's dive in. Investment return refers to the gain or loss on an investment over a specific period. It's the reward you get for investing your money. This can come in two forms. 1. Capital gain. This is when the value of the investment increases. For example, if you buy a stock for $100 and it goes up to $120, your capital gain is $20. 2. Income. This includes interest from savings accounts or bonds, and dividends from stocks. It's the money you earn just for holding the investment. The key thing to remember is that investment return is not just about the money you make. It also includes the possibility of losing money. Understanding investment return is crucial because it helps you. 1. Measure performance. It tells you how well your investment is doing. 2. Make decisions. Knowing the potential return can help you choose between different investment options. 3. Understand risk. Generally, higher potential returns come with higher risks. Remember, investing isn't just about making money. It's about making informed decisions to manage and grow your wealth. Calculating investment return can seem complex, but it's really about two things. 1. Total return. This is the actual percentage increase or decrease in the value of the investment. It includes capital gains and any income. 2. Annualized return. This is useful for comparing returns over different time periods. It shows what the average yearly return would be if the investment continued at the same rate. Here's a simple formula for total return. Total return equals final value of investment minus initial value of investment. Initial value of investment times 100. Text. Total return equals frac. Text. Final value of investment. Text. Initial value of investment. Text. Initial value of investment times 100. Total return equals initial value of investment. Final value of investment minus initial value of investment times 100. And remember, past performance is not a guarantee of future results. Let's put this into perspective with some examples. 1. Stocks. If you buy a stock and its value goes up, your return is the increase in value plus any dividends. 2. Bonds. For bonds, the return is mostly from interest payments, with some potential for capital gain or loss. 3. Real estate. If you invest in property, your return could be from rental income and any increase in the property's value. Each type of investment carries its own risks and potential returns, making it important to diversify. And that's a wrap on investment return. Remember, understanding this concept is a big step in becoming a savvy investor. It's not just about the returns, but also understanding the risks and how different investments work. We hope this video has been helpful in demystifying investment return. Happy investing, and see you in the next video.